Hi and welcome back to Siren Crypto. I'm Becky and in today's video we're going to be looking at trailing stops. We're going to look at what a trailing stop is, explain how it works and also look at how to add one to an open position. Now make sure you watch to the end as we will show you how to use a trailing stop to follow price swings or price trends. Firstly, here's our disclaimer. This tutorial is for educational and illustrative purposes only. We are not responsible for any investments made applying this information or buying or selling recommendations. Siren Crypto are not licensed investment advisors. We make no recommendations to purchase or sell any kind of coin, option or security. Any investment contains risk and is 100% the responsibility of the investor to assess the risks and rewards involved. Trading the crypto market involves a high degree of risk and you may incur financial losses if you engage in this activity. We at Siren Crypto take no liability, assumed or implied, from your application of the information we share within our training programs. Let's talk about trailing stops, but before we get into trailing stops, we really should talk about what a stop is. A stop is a type of dealing instruction, what we call an order where you leave at a certain price condition. When that price condition is met, then the exit of the trade is executed for you. A common basic type of stop is one that is tasked to an open position. So basically says, if a certain price is met, then exit my position at the market price and you close your position. So let's look at that in a little more detail to recap what a stop is. Now I use the 3 commas interface to execute and monitor my trades. So let's have a quick look now in Smart Trades and you can see we have an open position here. There's no stop loss on this trade. So let's put one on. I'll show you how to do that. So firstly, on the right hand side of your open position, you will see these 3 little dots. Click the dots and then they will open a drop down menu and simply click the function Edit. I then go to the chart for the particular coin that I'm trading and I put my stop loss below major support. On this particular trade, that's at minus 5.53% below the buy-in price. And lastly, don't forget to click the Save Changes button. Let's go back to our open position. We have our buy-in price and we can see where the stop is here, which is 5.6% away from where we opened our position. If then we click on the pairing, we can open the chart and we can see where we opened our position, where our take profit is, and where the stop on the position is indicated. Now this is not a trailing stop. It stays static unless we move it manually up or cancel it or our position is closed. So in this example, we have bought AE at 2350. We want the trade to rise, however, we've put in our stop at 2220, which takes us to about 5.3% below our buy-in price. If the market falls down to that level, then our instruction to close the trade is carried out and we sell out at the market price and exit our position. If we were shorting, then our stop would be above the opening level. To recap, your basic stop stays at the fixed level you have specified for that stop, and it will stay as a pending order unless you amend the level, or cancel the stop, or the market hits a stop, or you close the open position the stop is attached to. A trailing stop doesn't work in that way as far as staying at a fixed level. Instead, the trailing stop will move according to the conditions that you have specified. So basically, you are instructing the stop to be a maximum specified distance away from the current market price. As the market moves in your favour, the trailing stop will move up with it, maintaining that distance that you specified away from the current market price. For example, if you have taken a long position and you have placed a trailing stop at let's say 7% below the market, then the trailing stop will maintain 7% at the highest the market has got to since you opened your position. The trailing stop won't move further away from the market price. If, for example, the market starts to move back against you, the trailing stop will stay fixed at that point, and when the market moves up again in your favour, then it will follow suit. It will keep the specified distance you've given from the most favourable part the market has climbed to. The easiest way to understand this is to look at an example, so let's do that now. So with a trailing stop, you're going to specify a distance, just as with a regular stop. So let's say, for example, we want to put our stop in at 7%. On this example here, we're going long. So we buy here where indicated, and your trailing stop begins its initial level here, 7% away. As the market rises, your stop will move with it and remain 7% away. If the market drops, your stop remains at this level, and it will only move up when the market moves higher than this level. As the market descends, your stop is staying at the same level, and if the market continues to descend to that point, you will close out your position. Hopefully now you have an idea of what a trailing stop is and how it works in a general sense. Let's look now at adding a trailing stop using 3 commas to an open position. Adding a trailing stop is really very simple. We again go to Edit, go to Stop Loss and click Trailing here, and then we add in the percentage distance and press Save. And that's as easy as it is. The open trade then has a trailing stop applied. Let's go back to our open position and check the chart within 3 commas to see where our trailing stop is. We click the coin pairing at the left-hand side of the open position to reveal the chart. Given that a trailing stop follows the market as it moves in your favour, one of its best uses is as a complementary tool to help you when you're following price swings or trying to follow price trends. A trailing stop can be used as a psychological crutch, and it can help to enforce some of the discipline when following price trends and swings. A trailing stop needs to be sufficiently far away so that the trade has room for movement and retracement, and so that your trade doesn't get taken out by those retracements. It can get tough when the market turns around because these falls are going to look like retracements. We know when the market falls that the trend is over and we're going to be giving back a proportion of that profit. What we need to do ideally is to let the trailing stop do its job. The market goes through the trailing stop and we exit the trade, but we still have made the profit. Let's take a look at this chart. This is Link paired with Bitcoin. We can see the market has been rising. We took a long position as indicated, and we want to go with the flow and follow this trend up. We can see we've had a few little retracements, but you can also see 123% or so gains from this peak. So where do we want to put our stop distance? We want it to trail the market, so we want it far enough away that it doesn't get taken out by one of those retracements, but we also want to have it that if it does get taken out, then it's something that indicates the end of a trend. Let's say we have our trailing stop at 9% away. If the market does go up, then we maintain our exposure and we're still in the trade in our long position. The more it goes up, the greater amount of profit we will make. The trailing stop will follow the market up and force the decision that we have made. If the market reverses by 9%, then we're going to be out of our trade. Hopefully you can see how a trailing stop can help, and maybe a trailing stop would fit your particular style of trading. On the next video, we'll be looking at another approach to the markets. If you like this video, give us a thumbs up. Make sure you don't miss out on all of our videos by clicking the subscribe button. You'll get notified when our next lesson is uploaded. Well, I'm Becky. Thanks for watching Siren Crypto, and I'll see you on the next video. Happy trading!